Yesterday, a stock came on my radar, which is e-Mudhra, and I decided to reject this stock. MarketSmith recently made a video where they spoke about the positive aspects of the company, the fundamentals, the results, and the technicals. But when I looked at the stock, it did not fit in my personal criteria that I look for in a company. So that is why I am making this video to discuss my perspective on this stock. So let us first look at the chart. So let me expand this. So have a look at the moving averages. The 50-day moving average, which is the blue line, is above the 150-day moving average, which is the green line, which is above the 200-day simple moving average, which is the red line. So this is a strong uptrending stage 2 stock. It is consolidating. The base is getting created. The price is getting tighter on the right side. This is today's candle. So the market is live right now. As you can see here, we are in midday. So I saw this up till yesterday. I saw this candle. Okay. And I decided that I will not buy the stock. I rejected the stock because see this, there is a buy point here. If you notice, this 0.1, that's 0.2, that's 0.3, 0.4, and 0.5. So the high of this red candle is below the high of this green candle. So point number 3 becomes our buy point somewhere here. So I could have bought the stock as it would break above that yellow line, but I chose that I will not buy the stock. So there are more than 5 points in the base. There are more than 10 candles in the base. Again, if this candle closes like this, there is a new buy point. It will complete 6 points in the base. Moreover, the buy point would be in the green zone, which is the top quarter of the base. I normally divide the base into quarters. So the first quarter is the green zone, the second quarter is the blue zone, and the third and the fourth quarter constitute the red zone, which is the lower half of the base. I prefer my buy point to be in the green zone always. That's where I want to see price tightness. So I want to see price contraction. I also want to see volume contraction, which you see in this base. Moreover, whenever the stock goes up, I want it to go up on high volume. Whenever the stock goes down, I want it to go on low volume, go down on low volume. So you see red bars are below the blue line and the green bars are above the blue line in general. Okay, not every time, but in general. That is what I would like to see in a base, which in this case is true. So everything looks fine from a technical standpoint. Everything looks fine. So why did I reject the stock? For that, we'll have to go to MarketSmith. Let us open the details of the stock. We have to compare this stock with other stocks in the stock market. We also have to compare this stock with the Nifty 50 itself, the market, the general index plus the overall market. So have a look at this. So if you look at this, MarketSmith is already pointing out that there is a base which is called as cup with handle stage 3B, which means this is a middle stage base, which means the stock has already had a run. Now it is in the middle stage. If it breaks out of this basing period, it could continue to go on further, providing 50 to 100% return over the next few months if it breaks out of this base, and assuming the fundamentals of the company improve, because a stock cannot go up with weak fundamentals. Somewhere it will give up along the way. Okay, that's the highest probability. Now in this case, as you can see, MarketSmith is pointing the base, the moving averages are in place, the base formation is okay. What I don't like here is the stock formed a 52-week high in the relative strength line. Relative strength line compares the performance of the stock with the Nifty 50. So that line formed a 52-week high somewhere in June, middle of June. And since that day, the relative strength line has only been falling. So there is a falling slope If you join these highs, it will give you a falling slope of the relative strength line. So in the base, I don't want to see falling relative strength line. I want to see either flat or rising relative strength line slope. Okay. That is one negative factor. Another negative factor is the relative strength rating itself is 71. Okay. I want this rating to be 80 or 90. 71 is acceptable if all other factors are positive, but when the relative strength line itself is sloping down, then 71 is questionable, which means there are almost 30% of stocks in the Indian stock market which are doing better than this company in terms of 52-week performance. Now, 30% of 5,000 is like 1,500 stocks. So there are more than 1,000 stocks which are doing better than this company. So why should I put my money in this stock? Okay. Purely on a 52-week performance basis, this stock doesn't show enough relative strength. Next, if you see standalone basis, the recent quarterly sales growth is 49% and recent quarterly EPS growth is 179%. This is comparing June quarter with the same quarter last year. Okay, so June 2023 versus June 2024. So you see triple digit growth in earnings, high double digit growth in sales. This is fantastic. But when I click on consolidated, suddenly all these numbers change. So that is what I don't like. I want to see consistency. On a standalone basis, if the business is doing well, I want that thing to repeat on a consolidated basis as well. Consolidated means the company might be having some subsidiaries or some other ventures which is included in the calculation of the overall numbers of the company. When if standalone is doing well, that means the company must have bought other companies or the company is owning some other assets which are not as productive as the original business of the company. So that is what I don't like. This represents that the company is probably not allocating capital well. That is my understanding. So I want to see consistency. If standalone numbers look great, why are the consolidated numbers not looking great? This demands investigation. So rather than buying the stock here, I would spend time investigating the stock more rather than just buying the stock. Number of funds owning the stock has improved. That this is a good sign. Management ownership is more than 50%. That is a good sign. Up down volume ratio is less than 1. That is not good. Okay, up down volume ratio means if you look at the past 50 days, you look at the volume when the stock has gone up, you add up that volume, then you divide it by all the down volumes. When the stock has gone down, you look at the volume, you add up all those volumes. So volume on the days when the stock has gone up divided by volume on days when the stock has gone down, that ratio should be more than 1, right? Because we want higher volume on up days and lower volume on down days. That is not the case here. The ratio is less than 1. Okay, that's a sign of weakness. Okay, so master score looks good, not great, but looks good. EPS rating looks good, not great, but looks good. 71 is the relative strength. This is poor. Moreover, the group rank is poor. 145 is way down. I mean, out of 197, if you are ranking at 145, I'm not interested because you have to, the industry has to gain a lot of ground before it comes in the top 40 industry groups. So these two factors were the major factors which led me to reject the stock. Otherwise, technically, price wise, it is forming nice cup with handle pattern on the daily time frame chart. Moving averages look great. Earnings stability is there. The lower this number, the better. Okay. PE ratio is on the higher side of the range, which is normal for a growth stock. Cash flow is positive. Return on equity is decent at 11%. So everything looks fine. So 1.15, 2.48, 2.37. As you can see, the EPS is rising, which is a good sign. Volume is contracting in the base, which is another good sign. It's forming a long multi-week base. So everything looks great. What I don't like is the relative strength of the stock and the relative strength of the industry. My question is, if everything is great, fundamental, technical, then why is it that the stock has underperformed other stocks? Why is it that the industry has underperformed? So everything might be good about a stock, but if the market is not giving its verdict, then I am not interested. Okay. Another point I want you to notice is that if you look at the industry of this company, so this is computer software enterprise. So let's go to the industry. So computer software enterprise. See, computer software enterprise. As you can see, 6 months ago, the industry rank was 48, which in itself is not very great. Then from 48, it went to 102 3 months ago. But that means the industry performance worsened. Then from 102, it went to 129 last week. So the industry performance further worsened. And from 129, it is now at 145. So it is getting worse and worse and worse. Okay. Which is not a good sign. This is another major reason why I choose to stay away from this stock. There are other stocks where exactly the reverse is happening. The industry rank, instead of worsening, it is getting better and better. Okay. So I would put my money there. Wherever the money is flowing, I would put my money there, but not in this stock. I would give this stock more time. Of course, this stock is a leader in its space. If I open the industry, see, this is the chart of the industry. Not much price action. It has remained sideways for quite some time. If I click on stocks, see, this company has the second highest market capitalization in this particular industry group. So Infibeam and e-Mudhra, they constitute the majority of the market capitalization in this particular industry. So if I were to put my money, I would put my money in these two stocks if I want to take a bet on this industry, because these are the major movers of that industry. But see, in both the cases, the price strength has been low. So it's not been performing. Even we look at Infibeam. Let's look at the chart. I'm sure it is underperforming. See, the moving averages are turning down. The stock has been drifting down. The relative strength line has been falling aggressively. So there are problems. Group strength is poor, price strength is poor. There are problems with this industry. So I would like to temporarily stay away. I want the industry rank to start improving. Okay. I want to see standalone and consolidated numbers. There should be consistency in both the numbers. Okay. And then I would have the confidence to put my money into this stock. So these are the reasons why I am rejecting a stock. Remember, I had told you earlier that your trading performance does not depend as much on the stocks that you select as much as it depends on the stocks that you reject. Okay. Your rejection skill is more important than your selection skills. For every stock that you select, you should be able to reject 200 to 300 stocks. So you need to quickly learn how to start rejecting stocks before you select one which you simply don't find a reason to reject at all. That's the stock to get involved with. Okay. Because then it becomes easier to track as well, and those opportunities will be few. So I hope you got value from this video. Please don't forget to like, comment, and share this video so that this video reaches those people who truly want to become professional stock traders. I thank you very much for your time and your support.